Okay, good evening, everybody. It's Ken. This is the weekly question and answer session for the Advanced Swing course. It is May 20th, 2018. So let's go ahead and get started. So I was going through the question and answers. There was really only just one question for this week, so let me go ahead and get that one covered. And then I have just a couple prepared remarks to go over and kind of an update on the MACD histogram spreadsheet that I'm working through. So this one was from one of the folks from the live trading workshop, and was going through his notes. And so his question was looking at the super pinch. And he says, I see in the day trading notes that the Z3 are to be inside the pinch box, which is one hybrid, that should read HB, a hybrid, a FB, one frog box or 0.7 frog box. My question is, the pinch box used calculated using daily ranges, and does this hold irrespective of the intraday bars, regardless of the time frame? Because I have the impression that using 1 minute bars, there will be much more pinched moments than when using 15. That's a good question. And then for the definition of the frog box, do I use the ranges from the high to low, from open to close of the same day, or do I use -1? So really, let me get that one first. Just to be clear, this is part of the Z3 pinch, the pinch and stretch lesson. And if you look on the in the right board for the videos, there's like 3 or 4 videos on the pinch and stretch concept altogether, and it covers, I think, in really good detail, the intraday application and the swing application. So a super pinch is defined, the concept is the same for both time periods, but because of the difference between intraday prices and swing prices, they are computed a little differently. They have evolved a little differently. So I want to make sure that those two are clear. So let me talk first about swing trading, and then I will talk about the day trading. Okay. So for both of these, there are 2 criteria. So for the super pinch, what has to happen is 2 things. That the volatility has to have compressed to a abnormally tight range. And then the second thing is that all of the 4 regression lines that we care about, the 10, 30, 90, and 270, each one of those represents a fair value according to different time frames. Right? So for those, we want all of those regression lines all tightly compressed as well, that they are in agreement as to fair value. So you have to have both of those criteria established. One, the lack of volatility creates the pinch, meaning that a breakout from there has extra potential to be large. And the second thing is we want all 4 regression lines to be tightly compressed so that there is something like consensus about fair value. Then the next thing that happens is that price and the RL10 have to break out of that super pinched consensus. And then it's a question of, will the longer term time frames begin to follow that momentum and start chasing the trader's price, or is that current consensus going to act like a magnet and pull those prices back? So on the swing trade, what we're doing is we're saying that the target is pinched when the standard deviation of 30 days of range is less than the long-term average minus 1 standard deviation. All right. So let me unpack that a little bit. Let me get a blue pen. So on the swing, what we have is that the one standard deviation of range and then another standard deviation of range, right? So if we take the middle line as the Bollinger Band mean, that's the 30-period simple moving average on daily charts. And then the river consists of plus or minus one standard deviation. So these are shaded blocks. So that gives us that dark river. And then plus or minus 2 gives us the floodplain. And these are all standard deviation units. So these are all identical distances, right? So then we have the third standard deviation, plus or minus 3. And that's really where we've got that red line of the Z3 lines have been very wide. Because out here there were six big blocks of those, right? Not quite drawn to scale. But when the river is very and the standard deviation is very wide, the river is very wide. I usually show that middle one as red, right? So what we're saying is that for the river to be pinched, or for a pinch to occur, that means each one of these standard deviation boxes has to be small. And because they're identical, all we really care about is this, how tightly compressed on a percentage of price is that standard deviation. All right. For it to be very compressed, what that means is that for the last 30 days, the absolute travel time, the absolute range of this of the last 30 days has to be relatively narrow compared to, let's say, a long trending. When you have a long trending move, that 30-day range could be very wide, and the standard deviation of price is going to be large, right? And so in order to get a very compressed river or standard deviation, what that means is this has to have gone through an abnormally narrow price range for the last 30 days. That's how you get a really tightly compressed box. So what do we mean by abnormally compressed? So if we just drew a descriptive, using descriptive statistics, we said that was the average. And then if we go out plus or minus 1 SD, so plus 1 SD and minus 1 SD. In normally distributed prices or data, you get about 1/6 of the time the data is out here in the fat tails, and then about a third and about a third of the data is between plus or minus 1. So that means 2/3 of the time. So 2/3 of the time, we're calling that a normal width of this, and we're talking about the width of these little standard deviation boxes now. So for this to be tightly compressed, what we're going to say is that we're going to find the ones that are in this, the 1/6 most compressed boxes. And now instead of the last 30 days, which is how we actually compute this, that standard deviation, we're going to go back and look at 500 days. So in those last 500 days, we find the maximum percentage of these little boxes. So it's a percentage of price. And then we're going to find the min. We're going to find the average. We're going to compute the standard deviation of both of those, of all those 500 elements. And then we're going to say just these down here in the bottom 1/6, the bottom 1/6, the top 1/6, and then this 2/3 in the middle here, which is plus or minus 1, plus 1, and then minus 1. So when we say the pinch has occurred on daily charts, what we're saying is that of the last 500 trading days, this is one of the 15% most compressed widths of the river that we have seen. So by that, as a working definition, that's why we're saying this is tightly pinched. Now the other thing that we're going to say is that the four regression line, once we have this tightly compressed box for the width of the river, I use a measure to see are all four regression lines also tightly compressed. Now I don't do that as a, it works out to be about within plus or minus 4, or within 4 standard deviations of this river. So what I'm really doing is measuring the two regression lines that are the furthest apart, and I'm measuring that distance. And if they are within 4 standard deviations of each other, it just it makes them pretty tightly compressed. So they're like all within the plus or minus Z2. That turns out to be on daily charts remarkably compressed. So when you get both of those elements, that the pinch is exceptional and the regression lines are tightly pinched, you have all the conditions for the beginning of the next big, what could be the next big swing trading move. It will start off as short-term traders leaving the river, followed by 30, the RL 30, then the RL 90, then the RL 270. The more fundamental this move is, the longer it will last as it goes to find a new price, the new fair price. The more it looks like a head fake, the more quickly that RL10 is going to come back to that consensus. So it's a question of how much belief all of these traders at the different time frames have in the move. But what we do know is that when you have a tightly compressed pinch box and you have all 4 regression lines tightly compressed as well, you have both the lack of volatility, so it's a negative volatility, and a very tightly compressed consensus on price. Those are the two conditions that lead to the next big swing. All right. So that's the basic idea on swing trades, how we define it on swing trades. We're looking back 500 days to find all the statistics on how wide the river was as a percentage of price. We're picking just the bottom 1/6, or it's more than a standard deviation below the long-term average. That means that the river is narrow. That standard deviation box is very tight, and then off we go. Okay. Let me erase that junk now. Now, the idea of the super pinch itself began with the day trading, and so it uses our intraday measures of descriptive statistics, so it's a little different than swing trading. All right, so the main difference between those daily charts and the intraday charts is the gap. That overnight price action in equities creates a different kind of condition for price activity than you get from swing trading, which is relatively continuous. The longer your holding period, the less important those little daily gaps are. But that really explains why there's a bit of a difference. So, so the two criteria for day trading. Now, what we're going to use as our tightly compressed box, in this case, for intraday trading only, is we're going to use the frog box. So a frog box 1.0 is our mathematical definition of signal versus noise. We say that's the boundary between signal and noise. So the way I implement that is, if this price, gapped open, then sold off, and then started to move up, And we would say, at some point, we would say, oh, that big move up was a directional move. Well, how do I distinguish? How do I know where in this ladder? My question is, when does that become a signal that this is an actual move, and when was it just part of a noise move? If it was noise, we would expect it to do this and come and start chopping around. How can I distinguish between a signal and a noise and all of this noise in here? Well, as a mathematical definition, we're just using, for intraday trading, a frog box 1.0. So if we had a low of the day, and this thing moved one frog box off the bottom, when it leaves that, this is the boundary between signal and noise. Okay? So how do we get the frog box? We take, we look back 30 days, and we find the range of each of those 30 days. Not the true range, just the range. And so the range is equal for each of those days, the high minus the low, divided by price. So that we actually get a range percentage. And then to get the frog box, we then multiply that by today's price to come back and give us an actual dollar value of how big that frog box is. Okay. So what we're going to do is we're going to take the standard deviation of the range of the last 30, range percentage. And that allows us to compute the frog box. So when we see prices, we measure price intraday in units of frog boxes as units of non-noise moves. Well, what we found was that there were some times when you get this nice big move and then it finds its level, and then instead of getting further, it gets quiet and then really, really quiet. And one of the things that we noticed was that the Bollinger Bands would do something like this, and they would get very, very, this is the Z3 lines now, and it would get very, very, very compressed, to the point where out here, this might be 3 frog boxes wide, because there may have been a big gap or a very large directional move, but at some point, price has gotten so tight and compressed at the new fair value that even plus or minus Z3 all fits within one frog box. And we said, man, that looks like it's really pinched. So when the Z3 lines from Z3 to Z3 is less than a frog box, we now say intraday price is pinched. When the width of the from Z3 to Z3 all fits inside one frog box, that is pinched. And now to get super pinched, all 4 of our regression lines, the 10, 30, 90, and 270, all of those have to fit inside that same frog box too. So when you look at this, this is just a Mongasso of colored lines that are overlapping and all that stuff. And when you see that, what you can say is that for this one bright shining moment, everybody agrees that this price level is correct. Everybody believes that price level is correct. Sometimes you will see that thing come down to 0.7 of a frog box. We've even seen it at 0.5 of a frog box. So as these things compress and compress, now what we would take is a breakout from the Z3 lines now becomes that first move out of this compression could be the next big move down or the big move up. And what this sets up is two different strategies. One is the initial breakout, and the other one is the first head fake. All right. So on the initial breakout, what we've got is this. Excuse me. Here's the one, and I'm just going to use the 1.0 frog box, and we're going to say the Z3 lines have compressed into here. And now what we're going to do is we're going to play a breakout in either direction, And then if the breakout is to the downside, we're going to trail it with the width of that Z3 to Z3. Or if it breaks out from here to the upside, we're going to trail it with the width of that Z3 to Z3. So the trailing stop is always going to be less than a frog box, because that's what created the criteria. It was less than a frog box. So that's the first one, and that breakout happens and off it goes. Now what we've discovered is that if that thing is going to work without a head fake, then it doesn't reverse itself quickly. But there are some times when we have our little frog box here, we have our Z3 lines have compressed tightly. What will happen is price will make a little head fake and then quickly reverse and go the other way. So in other words, it has traversed this entire from Z3 to Z3. It gets the breakout, it gets this long. And so here's my rule of thumb on this. After 3 bars of success, then my stop was here, I move my stop up to this Z3 line here. And then if this thing sells back off, I cash it here. I immediately stop and reverse, and I'm looking for the far side of the Z3 as my initial profit target. It's normal in this condition too, which is the Z3. This is what we call the Z3PC, or the channel. There's like a head fake in there. We call this first one the Z3PO for a breakout. That one just, it leaves and then never looks back. The Z3PC is it left, it stalls. When it comes back to the original Z3P line, we scratch, we stop and reverse, and then quite often that's the one that goes. It could also go this way, where it has a little head fake down this way, and then takes off that way. Now, it's not unusual to see that one when you've had a nice strong move in the day so far that comes through here, and then it makes a little, like it's going to fake this way, and then reverses and goes. That's where we like to scratch it, scratch the short, and get long. And what will happen is, even if you just get to the far side of the channel and it stalls and you cash, you're actually net positive because you paid for the round trip and you made a little bit, and you're bouncing from channel to channel. But when I get this Z3 pinch, then what I like to do is, for the rest of the day, I just draw this band across here, and if it goes down and then up this way, I should be short here. 1, 2, 3. It comes back, I scratch, and now I'm long. If it gets to the far side of the river, I take my initial risk and move it up here so that I'm going to get no lose plus dinner for 2, and then off we go. And then quite often this is the one that really goes. And then I'm waiting for recoveries, and if I see this, then I have a low, a higher low, and now I have a continuation in here, a pocket entry, or I have an emerging dragon if it takes out the previous 10 period hump of the dragon or the RL10. And then you get this little continuation patterns, and they just keep going. So that's the intraday Z3 super pinch. They're computed slightly differently because of the different ways that we measure volatility between day trading and swing trading, because of the difference in price action, because of the gap. That's the biggest distinction. Okay? Any questions on that one before I move along? So that's what this question was about right here. Okay. So the next thing I want to do is let's see. Let me come to. I should have done this a while ago, but I just added this one into the weekend chart, just to give an explanation of how to use that ETF2, how I think about that. let's see, view, zoom to selection. There we go. Okay, so when we look at the summary report, and I sort it, let's say by, I'm going to sort by strength. Okay, so you note what I look at is these two columns here, the strength and the consistency column. So the strength is that it's the blended 3-month and 6-month momentum that we use for the blended monthly rebalancing. That's how we compute the strength rating. Only what we do is we take the regular score and then we convert all of the members of the database into a scale of 0 to 100. So in this case, the Spider for retail, XRT, scores at 100. And then consistency is the 10-week moving average of all of those strength scores of the last 10 weeks. So I compute that independently for each of those weeks, and then consistency gives you the aggregate. And now we color code these the same way that we do everything when I'm using that 4-color code: green, white, yellow, and red. So when I'm scoring all of those performances. Oh yeah, let me go back and answer Dave's question. For the intraday, there's no change to the pinch box regardless of time frame. No, I should. I'm going to add this to that answer. Use the 1 minute when the Z3s on the 1 minute get compressed. That's really the way to play that, because when the breakout occurs intraday, you're not wanting to wait for 3, 5, and 15 minutes. Now, as a description of a super pinch condition, you can still use those definitions intraday. And if you saw the Z3 lines of, let's say, a 15-minute chart or a 5-minute chart, all compressed to within a standard frog box, so the frog box doesn't change based on the size of the size of the time chart. But if you saw, let's say, a 5-minute chart all compressed within a frog box, realize that is 150 minutes of price action where the Z3 lines are within a frog. So that is like a super pinch. If you saw that on a 5-minute bars and then converted to 1-minute bars, you would have an extraordinarily non-moving price action. So you would not be incorrect to call that super pinched, but just recognize that in terms of primary time frame for execution, I like the 1-minute chart. You would not be wrong to use it as a descriptor, and I still think that it's tradable. But if you got above 5 minutes, then you're kind of drifting away from where this idea came from. Okay, so that's that. Okay, so now let me get back to this little rascal. So what we're going to do is we're going to say for all of these scores on strength and consistency and on the average, right? We're going to find the average line, and everything that's within 1 standard deviation of average, it's average up to +1 SD, we're going to color code white. Everything more than 1 standard deviation above is going to be green. Below average is average -1 SD, everything between average and average -1 SD. And then everything that's in the red is more than 1 standard deviation below the average of the database. So when you start putting those together, if the current strength is green and the consistency is green, what you have is, in my view, you have a great symbol, because its current strength is exceptional and its consistency over the last 10 weeks has been exceptional. So I just think that thing is great. And if you saw that on the ETF2 report, then as a swing strategy, that becomes one that I'm ready to just continue to reinforce trend following. And that's also one that I'm willing to use intraday as a turbo candidate, because everybody and their brother believes this thing is exceptional, and any kind of outperformance intraday is clearly a low risk idea. And so I'm very willing to turbo that one and green and white. Green and white actually even more, because this thing has been above average on consistency for the last 10 weeks, but is now exceptionally strong on the current strength. And that means there has been some recent new money come into that to make it begin to outperform in an exceptional manner. And so it was good, now it's great. And so I want to exploit new strength on this swing strategy. And if I'm already long, I want to look to add a second position. And I'm very willing to turbo this because it's so good. So these two here are really exceptional and wonderful things to participate in. Okay. By the same token, down at the other end, as you know, I love the extremes. And so on the extreme candidates, a red on strength and red on consistency is something that it's been horrible for 10 weeks, and it's still horrible. That means the pain is not over. So it's terrible in every respect. And so I'm going to monitor it on a swing strategy. As you know, I don't like to be short those things. I would rather be long and strong, the leaders, because the rebounds off the bottom are the biggest positive moves, and so I don't want to be staring that in the face. So I'm going to monitor red, and follow the trend, and look to see when is this thing going to become yellow-red. It was bad, and now it's just weak, and that means there's some new strength coming into it. But while it's red and red, my swing strategy is just to monitor it and follow the trend, and see when that trend changes. When does it slow down? That would be like it hasn't made a P1 yet. That's how fast it's failing. Now, for a turbo position, this is like my favorite candidate to pile on the short side intraday. When I see it violate yesterday's low of the day, then that means that the bears are still in charge and are pushing it lower. That's my favorite turbo intraday target of all. That's the collapsing dragon all day. All day. I also like red and yellow because this is the beginning of what could be a horrible long-term trend. It was just weak. Let's say it was maybe the previous week it was yellow and yellow. And now this week it just got really bad, and now it just went to red yellow. It was weak, and now it's bad. And now I can exploit that weakness. This is one that I might, if I was willing to hold things on a short swing, this is one where I actually might be willing to hold it, because we haven't seen a long-term failure commitment yet. So this thing could be bad for a long, long time. So that's one where I want to exploit weakness. But I also definitely want to turbo this one because the failure is just beginning. And so I automatically want to be short that if it violates yesterday's low. And I'm looking to use collapsing dragons and hybrid frogs to get into that one on a turbo trade. Now, some other ones I want to look at. This one that is white and green. This was great and is now just good. So on a 10-week basis, this thing has been exceptional. But now, this past week, it has only become above average. So it's had 5 days to recover, but it didn't. And now it dropped back down into the white. So this is one that I want to make sure that on a swing basis, I've at least preserved the profits. And I'm watching for maybe a resumption. Maybe there's a continuation pattern and a MACD histogram uptick once more, and then I can get back in. So I'm buying it on a dip. But this is one where I want to make sure that I have preserved my profits and that I'm not in a too big of a hurry to chase. Okay. By the same token, on the downside, this is one of my favorites. This is sort of like an owl pattern, but looking at these longer term swings. A yellow and red. Now, previously, it may have been red and red, and it was just terrible. But now some money has come into it, and now it's gone to yellow-red. So it got one quantum level better on the strength column. So it was weak, now it's just bad. I'm sorry, yellow and red. It was bad, now it's just weak. And I may be able to start exploiting new strength by using like an owl pattern and buying it and trying to hold it till it gets through the Bollinger Band mean and beyond. And it has a long way to go up this price improvement ladder all the way to green and green. And in the Dow 30 and the ETF 30, ETF 100, you'll often see these large sectors go through this cyclic pattern where they've been horrible and just terrible, and then they get slightly better, then they get back to average, and then they start slowly begrudging and getting above their 200-day moving average, and they start becoming the strength leaders. So if you can tap into something that went from red to yellow-red, and you can get a no lose plus dinner for 2 protection stop in there, now suddenly this thing can grow, and it has a plenty of room to go for a really good long-term swing. And so in the big indexes, where you're giving up some of those explosive moves, but you're getting the long-term, almost tidal trades, like seasonal cycling, then you can get some really long-term winners. And you're taking advantage of something like a value type of approach, where you find something that, hey, I don't think the energy sector is going to go to zero, but it's currently at red and red, and now it's yellow and red, and I can start beginning like a second or third mouse to begin buying my initial positions. And then if it gets to white, or actually white-yellow, then both the long-term and the short-term got better. And then it gets to white, and then maybe it gets to green and white, and then it becomes so good that it gets to green. That entire outperformance could last 3, 6, 9 months, and you will have tied into a really nice move with a really good initial entry that you were able to manage the whole way up. So this is how I think of that ETF2, not only as a system that can trade according to strict rules, but as a way to rapidly classify hundreds of ETFs and large cap stocks inside of a population, and then develop some shorter term strategies as a basis of that information. Okay, so any questions on that one? This just kind of puts into one cheat sheet the words that I have been using to describe these strategies over time. Okay. Okay, so the next thing I want to just show is, if I can, let's get this one up. So as you know, I have been very interested in the this MACD histogram, the 10, 30, and 5, because I feel like it gives a simplified approach to having directional bias. And so let me shrink this down. So, you know, we have price up in here, and we have the RL10s and the 30s and all that stuff. This is the S&P 500. But some of the price action can be a little tricky. And so what I've been doing is using the MACD histogram, let me make this a little bit bigger, to pick up a directional bias. So the MACD line itself is this bright blue. Let me see if I can get this highlighter. Yeah. So there are a couple spots that are really of interest to me. So the first thing is this zero line. Whenever the signal line is above the zero line, like it went above, it crossed over the zero line here, went over the zero line here, came down and almost tested it here, but then resumed up. So when it's above the zero line, from this point forward, I have a long side bias. When it crosses below the zero line here, I have a short side bias. Okay. What you'll notice is this thing goes through periods of compression and expansion. You know, this stuff really expands. In order for this thing to be compressed very tightly, what you end up having was a really long-term directional move. And the difference between the RL10 and the RL30, or the MA10 and the MA30, was very, very small, and so the amount of variation you get, the Bollinger Bands get very tight. And then when you have suddenly something like this, a large directional move, that makes these Bollinger Bands quickly begin to get wide. Okay? So the width of the Bollinger Band actually now becomes interesting. And it turns out that when we put these Bollinger Bands, and I'm using the red line on this one as this like a lava river, that's plus or minus 1. And then the yellow lines I'm showing is plus or minus 2. So that's plus or minus 1, and this is plus or minus 2. We can actually look at this when the signal line crosses its 5-period exponential. That actually acts like a P1. When you get a MACD histogram line crossing its 5-period moving average outside of the red river, this now becomes a moment of great interest to us. And then when you add this with the PSAR flip, this selling trend has now improved enough that we can start looking at a buying program, and then when it crosses the 0 line, it's confirmed all the way up and out of the red river, and then when it rolls back over, this is a place where you can start thinking about protecting that move. So let's see what that move looks like here. This entire move up is now signaled by the life cycle of this MACD histogram. So again, anytime you're above the 0 line, you can have a long-term bias. And then you look at something like this. This is especially beautiful. So when you have a really tight compression and it's all above the 0 line, that means this thing is grinding north. And now when you have a long-term move like that, the 10-period and the 30 moving average and the RLs all tend to compress very tightly. And that's why you get such a really small difference. So when this thing starts to decay and it comes down to the 0 line and then doesn't break through and go south, but crosses back over to the upside, oh man, this is the optimum buy on dip and the resumption of the move. And you get that whole thing. And watch this. All the way up, you have a long-term bias. At this moment, you might have decided to cash. That's the first sign of weakness we had. But then when it ticks up again above the smoothed average, the EMA 5, this is the second leg up. And then when you're up here, you have a clear warning because you were outside of the Z2 and it crossed over, and this entire long move all the way back down would not have caught you by surprise. So here's a way to get leg 1 and 2 and 3 to protect yourself against the sharp move. Now you know when you can be looking at the downside opportunities, and now you know when you can be looking at the upside resumption. So I really like this oscillating MACD histogram. So in order to now scan a lot of different symbols, I am now in the middle of completing my little spreadsheet because this is now a persistent enough edge that I'm going to add it to the official long-term repertoire, if you will. So just how I'm building this out. So those of you that are spreadsheet geeks, this is where you might find this to be of interest then. So the first thing I did was I wanted to make sure that the calculations inside Excel or XLQ were consistent with the signals I was seeing on stock charts. So I went back like 530 days, and I picked my usual 3 indexes just to check. And using this formula, XLQH close, I found all of the prices 530 days ago, 529 days ago, etc., and then all the way out to the current price. All right, and then from there, I came down to the moving average 10, and then I was computing these 10-period moving averages manually, and then the 30-period moving averages manually for the 500th day of the look back. And so I was able to compute what those numbers were by hand. And then I went to the MACD formula, went to the 500 days, and then looked at this complex formula. And using the XLQ formula for the simple moving averages of the 10 and the 30, I was able to do this all inside one particular cell. So I built myself some references. Let's see here. View, freeze panes, unfreeze. So when I build that spreadsheet out, I'm going to refer to these reference cells. So if I ever want to change the parameters on how I build these indicators out, all I have to do is I can change the quote source, today's date, what the fast moving average, the slow moving average, and what the composition of the EMA is going to be. So I can make one change here, and then all those formulas will automatically adjust. So that's good spreadsheet practice. So now I've computed what the actual MACD histogram the moving average convergence divergence is for that day by subtracting the slow one from the fast one, and when that turned out to be identical to the hand computed one, and then I checked that against stock charts and then TC2000, then I knew that the XLQ formula, and then I knew that this the construction of this formula was correct. Now I can easily copy that to all of these cells, and then what I'm doing is I'm building out my usual my usual symbol sets. So everything that's in category 1 is going to be like the ETF 30, and category 2 is the Dow 30. So then later on, when I can put filters on here and just select these different subsets of populations for the MACDs. What I'll do next is, and this is still work in progress, I will build out the EMA 5s and then find the standard deviations of those data so that I can start building all of the pieces that I need to recreate these charts. So the standard deviation is what's going to allow me to draw these, the Red River and then the Yellow River boundaries. And then I'll be able to do filters to find which ones yesterday were the RL. This is what I'm going to find, is find me the ones where yesterday the MACD line was outside of the Z2 and below the 5 EMA, and then find me the day when it crosses above, and then that will find me everything that made a P1 that day, and then I'll be able to do a subset and then build out those charts. And that turns out to be something that I'm very interested in. Whenever something it gives me essentially a P1 outside of the Red River, this is where I want to know what's going on so that I can start my buying program back to the zero line and then be ready to reinforce success when it gets above the zero line. So just for those of you that are kind of spreadsheet geeks, or you're looking at how does this stuff work, this is what work in progress in old Muppet Labs essentially looks like. And it gives me a way to tailor very specific functions or patterns that I'm looking for in a unique way, and doesn't tie me down to, let's say, other scripting languages and other patterns. It's just, I like doing this work in spreadsheets, so I don't find this to be work at all. And what I'll do is then, I will then be able to use this kind of data to build out a series of thumbnail charts that will end up looking very much like this one in the southern half down here, where I can find these oscillations and then use that to guide my my entries and my trade frames. And then, if you find that to be interesting, then by putting 500 symbols in there, then we can really expand our searches to find these extreme conditions where an extreme move has just been made and the turning point has started. That's sort of a way to find owls on short-term patterns. If we were to take a look at the S&P, let's go ahead and look around here about the 12th. About the 12th of February, we should see owls. So if I shift to the other form, if we go back to February 12th, I'm going to try to just shrink this up so we can see it a little more easily. Around February 12th. Yeah, actually, we don't get the you don't get the owl pattern until out here by the 5th of March, because it took that long for the RL30 to roll up. However, there are some opportunities down in here earlier in March where if you can frame your trade, you can have this sharp sell-off, and you see we had 1, 2, 3, 4 shorts, and then a cover during the swing. You can actually look that one up in the live portfolio management. Then when we got this reversal, we ended up buying this here as a 1, 2, 3 pattern, and then actually got 2 positions in, and then an exit up in here. So we were just trading on a swing basis using the PSAR flip and this extreme move on the RL10. And then if you drill down to the hourly charts, you would actually see out here around February 12th. Let's move this back a little bit. Yeah. Oh, just that's where the RL30 is. You can see the RL30. This is where we got that entry. So on hourly charts, we actually have an owl entry right in here, and then we get this beautiful move from 260 to 275. So there's a lot of, that's sort of a turbo trade there, where you start with a swing pattern that had an extreme move, and then dial down to the hourly charts, and then things start working out for us. Okay. So that's what that looks like. If we slow that down maybe to 2 hours, probably could see that even more easily. Yeah. Oops. 2 hours. Around February 12th. Yeah. So this was right after that Trump bump was over, and we got our exit after that long move up. And using collapsing dragons, we were able to get those 4 short and covered down here. And then right in here is where we picked up the owl pattern on the 2-hour charts. Look, we got an unambiguous move to the downside. We have a P1 outside the river. We have the dragon rolls up. We have the RLXD. The dragon rolled up. The 30 rolled up. And we got our entry right in here in this area. PSAR flip has occurred. And then had a really nice move all the way up into here. So that's where this is going long term with this spreadsheet for the MACD histogram, and this is the first inning, the first round of what will be a spreadsheet project for this week for me. I will be covering that in great detail during the live trading workshop and the research weekend in Kansas City for sure. We'll have all the write-ups and all the tools built. There's still room in that workshop if you're interested in coming. If you want to support it by getting the distance learning version, there's still time to get a hold of that at the discounted rate. I think that's going to go until probably 1 July, and then the normal price will happen. So up until 1 July, discounted rate for early subscribers will happen. More to follow on that one. Okay, so that's everything I wanted to cover tonight, guys. We're an hour into it, and that's a good place to hold it. So any questions from any of you guys? And if there aren't, I'll go ahead and stop the recording, get it processed, and then posted inside the swing course. Okay. So seeing no questions, keep up the good work. Hey, Elmer, you and the guys are doing a great job. Oh, Martin asked IQ feed versus, I think it's Northgate or Norgate. Well, IQ feed, I'm having good success with it because it has the very high quality and lightning fast intraday. It's much more expensive than Norgate. Norgate has beautiful data for end-of-day data only. I think if you're doing swing trades kind of exclusively with daily data, I think Norgate is just fine. And Tom Koo, who is an institutional trader, and he's working with Charles now to run a fund. He set up Charles to be a fund runner. They're using Norgate data for their swing trading, and he reports absolute satisfaction with it. And so that's institutional money being managed with that as the quote source. So I feel confident in saying it's pretty good stuff. And I would just say, Martin, I would get a hold of Tom Koo directly and just talk with him one-on-one to see what his experience with that has been. He will have certain insights that I don't have because I haven't been using it. But I've been following their ideas, and they seem really satisfied with it. And it is considerably less expensive. It's like, last time I looked, I want to say it was like maybe $200 a year instead of $100 a month for the IQ fee. So that makes a difference in the long run too. Okay. Any other questions? If not, I'm going to go ahead and I'll turn off the production here and say thanks a lot, guys, for hanging in there. And we will see you in the chat room.